reimagining private markets. We can start very quickly with why would we need to reimagine private markets generally? It doesn't seem like it's having a hard time growing on its own. It's doing quite well. It's probably the fastest growing part of the asset management industry. Why do we have people here from the infrastructure side, the TradFi side moving into crypto native, the crypto native pioneers of tokenization, liquidity providers? You're all focused on fixing a problem that 1% of the audience doesn't think needs to be fixed. Why are we reimagining private markets? Who wants to start? That's a big one.
Yeah, I mean, I'll start. So here, Christine Moy from Apollo. Thank you for being here. Like, really excited to talk. We are a significant participant in the private markets. Almost $1 trillion assets under management across equities, credit, insurance, retirement services. And I think for us, like, what we think about in private markets is how do we broaden access to private markets? Like, why? Because essentially we want to expand what we're good at doing, which is creating excess spread per unit of risk, like basically generating alpha for investors, so that they can retire better, or so businesses can kind of be better. Now, private markets historically, and as you said, like it's a significant market and it's growing quickly. Historically has not had a lot of technological infrastructure. And so, we are talking about reimagining it, but really it's kind of like a blank slate in that a lot of processes are still, kind of somewhat manual. And, there is actually the opportunity to build some of the industrial scale infrastructure that exists for public markets, but actually use new technology. Blockchain technology specifically. So yeah, I would say that there's a lot of excitement about it because, because we can use some of these new future-proof technologies, we can also enable superpowers for private markets, which I'm sure we'll get into.
So moving
away
away
that's like the context.
Moving away from spreadsheets and into the new era. And maybe Talia, it's a good segue. So kind of what I actually think it would be very helpful to give just some of the magnitude and scale of what DTCC does and help people understand a little bit more about it, and then how you're thinking about kind of at the base layer of all of this, what we need to do to get private markets reimagined.
Definitely. So I agree with Christine on the imagining. I don't know if we're in reimagining. I think we're in imagining. How many folks here are familiar with the DTCC? Oh, good. More than perhaps we thought. So for those who aren't familiar, DTCC is the Depository Trust and Clearing Corporation. We were founded about 53-ish, I think, years ago, basically to bring infrastructure to the public markets in the United States. We process 4-ish quadrillion in securities a year. I looked up before. Does anyone know how many billions are in a quadrillion? It's like a number so big it doesn't even make sense. I think it's 1 million billions in a quadrillion. So we process 400 billion millions of trillions of things, right? Like, it's insane. I keep saying to our marketing people, like, we should probably not even use that number because it just doesn't even it sounds fake. But we process that every day for the public markets, right? It's remarkable the size and scale that this operates at. I joined the company about 8 months ago, leading our wealth and investment solutions business. Within that business, we process upwards of 85%, if you include money market funds, of the fund volume in the United States, about 94% if you don't include that. If you're American, what that means is if you have a 401k, every time you put money into that, we're helping to make sure that gets to the right place. So DTCC operates at this massive scale for public markets, and what we do on the private side is that we have a platform today that processes about 13,000 private funds. So it's one of the largest private fund platforms in the world, with over 3,000 entities on the platform. And most people know us for our core clearing and settlement capabilities, not exactly what we do on the wealth and investment solution side. And as you said, Michael, right, some exciting news out of DTCC last month, right before Christmas, is that we received a no-action relief from the SEC to tokenize a portion of our inventory. So we hold in inventory on behalf of the US markets about 100 trillion in asset value.
Not quite a quadrillion yet.
Not a quadrillion. There isn't a quadrillion worth of stuff in the world. So that's basically any public security in the United States is held there. The fact that we got this approval means that a portion of that, which includes US Treasuries, the top 1,000 stocks in the United States, the Russell 1,000, and a portion of ETFs we've been approved to tokenize. So as all of us talk about how do you gain access to those markets, we're really focused on how do we think about enabling that at such a broad scale. And then when we move to private markets, what we already do in the fund space, we're looking at how do we expand that both for private shares and private credit in ways that bring the same level of safety and soundness to the market, which we take extremely seriously, and it's a very mission-oriented organization.
And just to give an idea of the size of private markets within DTCC, what is that area of the market composed of?
So it's in the billions, not the trillions yet. I'll point you to our website. There's only so many facts 8 months in that I can memorize, but 13,000 funds. I mean, Christine, how many funds does Apollo have?
I don't know, actually.
Yeah, we should bring up GPT on here. So, right, so it's 13,000 funds is probably the largest funds platform. And what we do is that we connect distributors and manufacturers to the fund managers to enable the processing of that in a really efficient way, like basically with the click of a button.
Mm-hmm. So this has to be music to your ears, Bhaji, right?
Yeah, I mean, a lot of times I think that we get hung up on what technology it is, but the simple answer to that question is that technology makes processes better. It makes them more efficient. It makes them faster. It creates better transparency and visibility. And it's also the language of this next generation of consumers and investors and users who are on-chain native. So adapting now ensures that the markets that we create and the capital efficiency that's enabled can be better for all existing holders and investors, but then it's also the language that the next generation of investors will speak as well, so preparing for that.
Got it. And then I guess you can't wait to get your hands on these things when it makes sense. So Wintermute, dominant liquidity provider in the industry, trading firm, investment firm. What does all this mean to you?
I think primarily it's about basically our capital being used more efficiently, because what we're doing now in DeFi, but also on more centralized exchanges is, okay, we park stable coins, so we park fiat there, it doesn't earn us any interest. Like the most obvious thing is, okay, like if some of it was in money market funds, for example, like Apollo, like it would make perfect sense for us. It would earn us yield, it would earn yield for people who hold their assets on exchanges. We could provide liquidity in those money markets, which would be amazing as well. It's basically just opens up, yeah, whatever, 13,000 funds, yeah, making markets on all of them. It sounds really amazing for us, yeah.
It's good for the Wintermute business, right? Okay, so I guess with everything in crypto, the question's always is if things are moving maybe slower than we want, is it product or distribution? That's always a heavy debate. My view has always been fantastic distribution and decent product is successful. Poor distribution with any product is not. And great product, great distribution is everybody wins. So what's the perspective of the panelists here? Do we think it's more of a product issue, more of a distribution issue? Is it just off-chain and on-chain are not speaking to one another in a way that's, beneficial to the greater good, or is it just everything's fine the way it is now and we don't need to push and we'll find these little areas, pockets of success and continue to push things forward until DTCC tokenizes a few quadrillion dollars of assets?
I can start. I think, back to the history lesson. So in 1986, the manufacturers and distributors came together and built this platform called FundServe, which is our mutual fund CIT and interval fund platform. That process is annually, we just crossed this threshold last week, about 12 trillion in settlement volume on an annual basis. So that's, your 401ks are processed through that. And 2 weeks into the job, I was with our advisory council and they came together, and it was this really interesting moment where a lot of the folks on the advisory council actually were the ones who built the platform in '86. So it's the 40th birthday of the platform this year. We'll invite you all to the party if you want. The way they came together was effectively that they said, we're basically processing checks till 3 a.m. Like the people sitting in that room, that's what their jobs were. And if you think about DTCC in general, we were founded because of this thing called the paperwork crisis. Is anyone familiar with that? No, neither. All right, we got one. The market used to close every Wednesday in the 70s and 80s because of how much paper there was to process, which is remarkable, right? So they came together and they said, how do we distribute these funds in a better way, and developed this platform. And one of the things that like I've come to appreciate is that in order to enable that distribution, no one can do that in isolation. And I think a lot of times, I spent the last almost decade working at Digital Asset Holdings and Bank of New York, running the digital asset product team there, focused on tokenized funds over the last 18 months. And I think there's this view that tokenized funds, peer-to-peer, et cetera, is just like the panacea to fix it all. But it's very difficult for people to get access to that, right? Our 401ks, I'm just going to keep using that example, like you don't have to think about it. The money just ends up where you want it to go. With tokenized funds right now, it's a very clunky process. The user experience is poor. And that's a distribution problem at its core, right? Apollo might make an amazing fund, but if you don't know how to get it and it's complicated to do it, then it's very hard to get assets into that fund. So I think the ethos of the digital asset space in crypto historically has been like this very isolationist view. And I think the next phase of this needs to be coming together and developing for collective success versus this individual success.
But is it a distribution or a product? Because for me, it's sounds more like product that is just too disjointed, to like less, not as efficient yet. That all of this like Legos are not fitting together.
Well, I think product from not a technical perspective, product from like Christine creates a fund, that's a product as an example. So I don't think it's the products don't exist. I think it's how do you get them?
Yeah, I mean, like, let me zoom out and like just share my perspective as a GP who's issuing private credit funds on chain. Like why we are going on chain is a few different reasons, and actually I categorize it in 3 different reasons. Like the first reason is what Bhaji pointed to, which is, first of all, let's just like say that there's $4 trillion of capital that is like, kind of sitting out there in the crypto ecosystem. And that is sitting exactly outside of the existing banking and asset management system. We know this, right? And we know that this is comprised of hundreds of millions of investors, ranging from quote unquote institutional to crypto family office, mass affluent to retail. And they all skew younger, right? So as a GP, like what I'm really interested in is like, who are those investors? What do they want? How do I, and assuming that they're younger, how do I become like, the first proper TradFi asset manager in their portfolio? How do I meet them where they want to be, which is in their wallet, and learn from their behaviors? Like, and we know that the behaviors for this next generation are completely different, right? Like as in, you see this manifesting in DeFi, meme coins, GameStop, like, the whole gamut. Like, let's just say that this is an active investing crowd. Right? So like that's the first like way to think about it, like in terms of why this matters. And so to your point, that's kind of like a distribution thing, like a new frontier of distribution that's interesting. However, once you have the assets on chain, what you have is the opportunity to build new superpowers for your private markets funds. And this usually falls into 2 different categories. Like, the one category that everyone talks about is private markets generally is always illiquid or less liquid. And by the way, tokenizing it is not going to just immediately make it liquid. However, by putting our private markets assets in this format, in essentially like a network ecosystem, there's the opportunity to enable more secondary trading or instant liquidity. Like, there's a few different mechanisms that we are actively researching right now. And by the way, like we do this because the crypto native crowd, the younger generation, want to get active. They want to have that instant liquidity. But guess what? Your traditional LPs that are investing through the private wealth, through the private banks, they also want liquidity also. Like they also don't want to wait until the end of the quarter or until the end of 3 to 5 years to get out of their position. So features that we are designing and building for the crypto native audience, when they become good enough, when they become industrial in scale, they will actually convert and bring the traditional LP base, because they'll be like, wait, like if I just buy this the regular way, I don't get instant liquidity. Like I want to have that flexibility. The second superpower that we can give private markets is the ability to, a different type of liquidity is like financing, being able to use these products as collateral. And we've been doing a lot of experimentation around doing that in DeFi.
So
teeing up Bhaji from Centrifuge.
And this is the exact answer to your question, where it's not one or the other, but the distribution is the product. So one of the really cool things we've been doing with Christine is bringing her fund on chain and figuring out how do we make the on-chain version better than the off-chain version. She set it up very well. The two primary solutions to do that are 1, greater liquidity, and 2, greater utility. On-chain, because liquidity is king, everyone is looking for ways to solve this. There's LPs, there's liquid funds, there's marketplaces and technology providers that can fully automate this entire process. So for the ACREDX Apollo fund we have on-chain, there is instant liquidity. Second piece, and just announced just live today,
Breaking
being
news.
announced right now for the first time
With our first
ever.
investor in the crowd. Hello.
With Lubin.
there.
Woo, woo,
Right
first
over there, first investor in the
investor.
crowd. Thank you for being a frontier investor.
So ACREDX is available on Morpho to use as collateral. What that means is that you can buy ACREDX, you can deposit it into a Morpho market, and you can borrow against that. You can loop that, and you can have this automated on-demand strategy where you can be using ACREDX as a collateral asset, which is an incredible path towards utility and efficiency for this product. The baseline yield is about 8%. With the borrow rates where they are right now, that becomes a very economically viable looping strategy, as known by Lubin from Architect, who made the first deposit just this morning. So it's really, really, really cool that we're able to say, now there's a product where you can have the equivalent underlying off-chain, but the on-chain version is better. There's better liquidity and there's better utility for the tokenized product. So that's a huge effort for Christine, for being a visionary, being early, being open to innovating and trying new things, but also this marketplace of DeFi protocols and founders and builders who are coming together to actually do new things. And it's Morpho, it's Stakehouse, it's Apollo, it's different liquidity providers. It's so many folks who really want to actively solve this challenge. And that's something that is very unique about on-chain and tokenization, is that the folks that are drawn to it are the innovators and the early adopters and the visionaries who want to solve these challenges. We might not know exactly what that path and that roadmap is today, but we're making the steps to get there together.
And by the way, just to tie it back to the regular off-chain crowd, this idea of you take your private credit fund investment, post it as collateral, and borrow dollars so that, if you're typically a private wealth client, go buy your jet or whatever, that is something that exists today. That is just called fund finance. And that is offered by every major private bank, right? So, I know it sounds so completely terrifying when you call it DeFi levered looping, but it's actually just fund finance. And in reality, it's fund finance where it's instantly settled. You have all of the multi-party bookkeeping on this ledger, right? So there's no reconciliation. It scales to any size. So by the way, when it's offered traditionally, there's a whole bunch of documentation, you have to set up the accounts, you have to kind of make sure you can manage the collateral. But this is literally roll up to your wallet, press the button, get the money. And that scales whether or not you are, talking about millions of dollars, thousands of dollars, or hundreds of dollars. And so that is also kind of incredible. It's sitting in two different worlds, but you can see how it could converge in the future when the technology gets industrialized and there's more mass adoption.
Well, not to pick on Lubin too much, but we talked at the bar on Tuesday, and he made the deposit on the ski lift today. That's the new generation of investor. Interesting product, interesting access point. I'll buy it.
Interesting way to fund your new private jet.
Can I make a comment, Michael, though? I think not to be the bear in the room, right? But I do think there's a question when we talk about collateral. Collaterals, folks who've worked in collateral are the doomsdayers of financial services. So I spent the first 7 years of my career, that's how I know Christine, doing collateral management and quite frankly being trained by the people who called the default on Lehman. So you want to talk about the doomsdayers, they were in the room literally when it happened. And when we think about collateral management, right, we're trying to protect the system, not for every day, and my new friend Lubin here on his private jet, right? But we're trying to protect the system for people and their mortgages and the real macro, back to the quadrillions and the size and scale there. And I think it's incredible. And how do we prove that we can do it here? And then how do you scale that when you think about back to the product conversation? Like, what is most of the collateral in the world being used? Like, anyone familiar with repo, right? Most of that's government bonds, right? That's like considered that or cash, the safest form of collateral. There is risk inherent in these private assets. They're not priced every day. They're not priced intraday. They're not, many of them not even priced on a monthly basis, right? There's inherent risk there that I think as we think about how do we scale this, there's principles that one needs to take into account that don't just depend on being able to click a button on the ski lift, but all the like non-sexy stuff that comes behind that. Pricing, operations, the doomsdayer people are not the fun people to hang out with at the bar, right? To talk about these things, but they are real. And when stuff gets bad, it can get really bad.
Yeah. I think you're exactly right. I mean, I'm at Apollo now, but previously I was at JP Morgan, and I actually built intraday repo with all of the doomsdayers. And basically, you're right. It's not just about the technology. It's about having the legal and regulatory and compliance stack that goes with it, having full title transfer so that in the case of default that you're actually going to be the ultimate beneficial owner, having the right MSA document. But the thing is, we built that back in 2020. It's been done. And that was actually on an Ethereum blockchain. So it's definitely been done, and actually I wouldn't say it's at scale. It's only transacted a couple $1 trillion of tokenized treasuries in dollars. In the whole scheme of the repo market that you're talking about, that's pretty small. But I think if we take the pieces together, we take what we learned from that, minor pilot that was driven by the doomsdayers. You take some of the, next generation technology that is live today. You pair it up. I think that works.
Yep.
I think that works. I think that scales. I think that sings.
So then, for the vast majority, for the repo world, for example, tokenized ACRED. Again, a great way to finance a plane. sort of a very, maybe a narrow audience, maybe not. It is
Come
frankly
on,
just
we're
good.
at the right spot for this. I thought that would resonate with you.
It is broadly attractive, I think, to basically anybody.
Okay, Sex in the City.
No, I'm talking about ACRED, tokenized ACRED.
ACRED X.
Private jets are attracted to everybody, but I'm talking specifically about being able to loop 8% yield. So, in the world of repo. Because effectively you're always trying to find, arbitrage creates action. So in that world, is it that the acceptance of that collateral for someone like Evgeny and Wintermute, is that the appeal? Is it that it's a more malleable, more liquid form of repo, which is already fairly liquid? What is the reason that that larger segment of assets that has less risk associated with it needs to be tokenized? And maybe you can answer that question, and you're thinking about it in your own context of your business.
Yeah, no, I mean, it is a pretty.
You're still on the private plane, I know.
Yeah, I'm still need to get there. Yeah, I think it will take some time to get there to start with. I'm definitely not in 1% people, but I'm not in majority either. I think it will take a bit of time because it takes time to build it. What we see now is very fun, very optimistic, very cool experimentation. But yeah, we'll see how this Morpho experiment goes. We'll see how more experiments go. But we are still very, very far away from this thing being actually efficient as basically TradFi rails. And so I think it will take us at least 1 or 2 years to actually see, those experiments being efficient for market makers, being efficient for exchanges, being efficient for, platforms like Morpho and Aave to actually accept it as collateral, not on small experiment basis, but having them as, 50% of all TVL, for example. Stuff
but I think it's what are you trying to solve, right? The stuff these guys are doing, it's trying to solve a different problem than doing repo at scale, right? Repo at scale is how do you move collateral overnight? How do you move collateral intraday, to Christine's point, in a faster, more efficient way? How do you move collateral cross-border, right? That's something that doesn't get talked about a lot. How do you finance transactions in minutes, even intra-minute versus intraday, right? Those are, it's really about the problem you're trying to solve. I think there's a difference between proving out that something works operationally and how do you get it done, and the really to your point, like cool parts of it. And then there's how do you do it at scale. And I think the thing that perhaps if you haven't been in the bowels of the financial system, like I used to work in banking, and now everyone in my life has been like, could you get any deeper in the stack? I don't think it gets deeper than DTCC, luckily. But if you've been in that environment, like how embedded and plugged in institutions are and how expensive it is for them to change, like we change a field on a report, I have to go to like 90 clients to get their thumbs up. You want to change the whole operation of the system. That's not something that's going to happen in a year, 6 months, but there are incremental steps one can take to prove it out. But I think there has to be a realistic expectation of how these things can and should move.
And then the demand and the draw is really just what you mentioned, so risk mitigation. So more efficiency, and in that process, you're de-risking just given the speed at which it can operate, which should ultimately reduce cost of capital or just general rate.
I think it's de-risking, and there's also financing opportunities, right? Like if you can do something intraday, that's a different business proposition than if you evergreen or overnight or.
Which should collapse the cost of financing, which is what would draw people into this.
No, but I think it's also about finding the limit, right? Like, sure, like T+1 settlement sucks, yes, but like, can it be atomic? I actually don't think so. Like, I don't think this system can be like.
There's not enough capital in the system.
Yeah.
Everyone talks about like atomic settlement, and that's a very beautiful idea. There's not enough capital in the system.
Maybe it can operate like on a minute basis, but probably not. Yeah, like I think there will be this limit that we will find over the next few years where it will make the whole system way more efficient, but it's not going to be. I really don't believe it will be atomic.
Well,
Yeah.
TradFi's challenges are DeFi's opportunities.
Yeah, and I
Very
think
Bezos of you.
like yeah, Bhaji was waiting to use that. She was waiting.
set me
But
up
like,
there.
but I mean, like, what's really interesting is like what you can hear here is that there's an inherent tension between like, you know, actually industrializing and like sort of updating like significant market infrastructure versus like what the technology can you know sort of you know effectively deliver. And like there's like almost like the speed, the pace, like everybody, like it's just moving a lot faster now, like with blockchain and distributed ledger technology because it's multi-party. And I'll give you a perfect example. Like back in the day, like before, you know, all of us were kind of in this space, if you wanted to innovate on market infrastructure, it'd be like one team at a bank that had one idea that like spent an enormous amount of time like socializing it, getting budget, buy-in, and then building it. And then it would take them about a year to build, and it would take about like another few months to like test. And by the time you debuted the thing, you actually didn't know if you had product market fit. And like that was sort of like the old way. Now, like because this is now like because blockchain and distributed ledger have sort of brought together us as like a multi-party ecosystem, we are building together, and so therefore the innovation and the iterative cycles are much quicker, like multiple times faster because you can have hundreds of like tens of teams, hundreds of teams like working on the same problem, but in totally different ways. And sometimes you just get like random-ish, like you got like computer scientists trying to build like, you know, financial like market infrastructure, and you're like, you don't know anything about finance. But you know what? They're not constrained by the constraints of like, you know, what you, like this is how it's always been. Like they can have a little bit more blue sky thinking. A lot of that doesn't work, but like it's helpful to like push the technology forward. But I'll give you another tangible example. Like, so, you know, we tokenized our private credit fund, as I mentioned, and Hadi over there, like, you know, he wanted fixed rate, fixed term borrow lend, right? And I was like, well, like we don't have that right now. Like, and he's like, well, I want it. And I was like, all right, well, I don't know, let's do it. And then like literally 3 weeks later, he came back and was like, yeah, so we built it with Gaevoy, right? And Zarta. And so, you know, like do no effort of my own at all. Like I'm not even sure I even responded to the Telegram fast enough. It was like already done before I responded. Like, you know, like basically other teams were able to take the token like where the token standard was, the fact that it was on a network, and then innovate and build like their own solution on it with their own technology. So when you have like pockets of this happening all over the place, like innovation is just like multiplied like acceleration.
Yeah. I mean, I feel like if
incredible.
there's enough people focused on creating solutions for capital will always find solutions. If there's enough people focused on it, enough incentives. I actually, funny enough, the founder of Zarda was very excited about that deal. I didn't realize that was you two. Okay. Okay, so I guess the other part about this is I want the audience to not just hear the words, but understand how they would actually do something like this. So I'm going to ask you, Bhaji, and by the way, my phone died about 20 minutes ago. I am way off the script.
I thought we said we were going to stick to the
yeah,
script.
the script is gone.
Read the questions.
Yeah, script is entirely gone. And so let's just walk someone through the process of your new facility for ACREDX and Morpho. How would they, I open my phone or my computer, how would they go about doing facilitating this type of transaction?
Yeah,
So you're all paying attention now because this is your way to get your capital out of your 2% yielding bank account into something that makes more sense.
Yeah, it's very simple. Just go to app.morpho.com and search ACREDX. You'll find the vault created by Steakhouse. Very simple. But ultimately, to take it a step back, everyone says, how are you bringing more capital on chain? How are you bringing more capital on chain? And Centrifuge, we were founded in 2017. We were always focused on RWA. And I think you mentioned this earlier, there's been a ceiling towards growth for real world assets. There's not transferability, hasn't really been great liquidity. You can't tokenize an asset and bring liquidity to it. So we've been focused on, first, how do we bring great assets on chain? And then second, how do we make those assets on chain attractive to a new investor base? So part is simplicity of how you access these. Part is what you can do with them once they are on chain. And then part is just broad education around these products and the benefits of these products compared to their off-chain version. So we're very early in that process. I think step one is tap existing capital sources to bring that money into these tokenized products. Step two is to fundamentally make those products better. And that's what we talked about around liquidity and utility, but it's also around operational efficiency, transparency, 24/7 settlement and trading. And then three is, okay, does that actually then convert to more capital on chain? So that's the big area that we've all been focused on, and I think starting to make incremental steps in that process.
Yeah.
And the last thing I'll also mention is that I think there will just be more capital on chain. If you believe that there will be more stablecoin adoption, then that's more capital on chain. And if stablecoin pays marketing rewards or not, that will still be yield-seeking capital, and that will be what will be invested in tokenized products.
Well, especially if it doesn't pay.
Yeah.
If it doesn't, what's that?
Especially if it doesn't pay.
Yeah, well, exactly. Well, that's. I mean, Brian Moynihan's shouting that $6 trillion of deposits will move out of his bank if stablecoins are able to earn yield.
Yeah, well, we were talking about atomic liquidity. The one interesting challenge we're looking to solve right now is atomic yield. So any stablecoin that's sitting idle can swap into a yield-bearing asset, generate yield on that idle stablecoin. It could be a minute, it could be a couple days, it could be weeks. And then once it goes back into use, then swap back into that stablecoin. So these types of atomic swaps and interoperability and connectivity across DeFi are what make the user experience better.
I think too, though, thinking about how do you get access to those assets, right? So if you're trying to get access to US treasuries, US dollars, et cetera, what is that bridge that goes between and I hate the term real world assets, but I'm going to use it because everyone
I was the first to say it, I'm sorry.
Well, it's just then you're saying, are the other assets not real? It backfires.
On-chain finance.
Yeah, so the on-chain assets versus the off-chain assets, let's just say, right? And I think when we get to the point of okay, if you want more assets on-chain, how are you getting those? And that's why and I don't just say this because I work there, but I do think that what DTCC announced in December was probably the biggest thing to happen in the tokenized asset space, because now we're not saying only use our chain, only use what we have available. What we're saying is you can now access this inventory in a way that's safer for investors, right? There's not 6 layers between the tokenization platforms and the underlying asset itself. We're thinking about, to Christine's point, those legal rights and obligations, the title transfers, all of those things being embedded at the source. And that's an extremely powerful thing if you're trying to get it in the hands of more people in different ways. We're not trying to control and say, only on DTCC's blockchain can you do this. We're saying access the inventory that's held here in a safe way. And I'm really excited about the opportunity that you're seeing financial market infrastructures connect with fintechs, with DeFi protocols, et cetera, to say, we want to help, right? We want to be at the party. We're not trying to be over here saying that things are going to leave our bank. What we're saying is that we're we're excited to be a part of it. And I think that's pretty powerful.
I think ultimately the source would be the issuer, right?
The source of?
The source of the asset. So I think there's a question of like, will ultimately Apollo go straight on chain first?
I think the thing that that happens in practice though is that does Apollo, I'm just, because Christine's sitting here, I'll use them as an example, right?
We'll give you a second.
A fund issuer, right? It might be easy for that specific fund, but how do you do that at scale, right? So there's infrastructure that needs to be built there. But if you think about the equities market, right, like the public US equities market, for every one of them to have to plug in, the system was built for this to become more efficient. It's extremely expensive to not have these standards and standard operating procedures to do that. It also means that folks like Wintermute would then have to directly plug into each one of those issuers, and that's just also not realistic. Samantha Jones, I feel like, by the way, would really definitely want your credit.
Wait, what?
Fund. If we're talking Sex in the City, I feel like Samantha Jones would want the credit
That is what I was
fund.
told.
Yeah.
I am. That is my character.
Oh, that's him. No, I was going to say, like, one thing that remains, like, kind of a friction point that, hopefully someone here will help solve is, like, come on, ecosystem, like, it's multi-party, we got to accelerate the innovation on this front, is the fact that, when you're operating in crypto assets, like, it's quite seamless because it's permissionless. But when you introduce on-chain assets, real-world assets, whatever you want to call them, there needs to be proper KYC, AML, and onboarding. And, that process, there are opportunities. There are opportunities to make that better. It is a little friction today, because especially since the audience that is being addressed right now is a crypto-native audience that is accustomed to that permissionless experience. So, the thing is, like, if we could solve this user experience point, and essentially, I don't know if it's like a network utility of identity or shared reliant KYC, something or another. But essentially, if you could do this and scale this across chain and across different tokens, or scale across different wallets and usable by various tokens, and essentially affect the same permissionless, seamless experience, but with the proper compliance. Josh, I'm looking at you. I know we were talking about this. I think that would be a huge unlock of capital and investors into this domain. And by the way, like, as soon as you got a lot of capital investors around, you're going to have a ton of issuers and asset managers around wanting to offer something to that audience. So, I think this is kind of something that still needs to be addressed. All this other stuff is great. And, there are multiple different pieces, the liquidity, the financing, but I think that it's boring, so no one really wants to work on it. And, like, many bank people have tried to work on this and have, died along the way. But, I really
still alive,
think
Christine.
it's still alive, or, like, have gone into blockchain or something and done something more fun. But, like, basically, I think this is the most boring unlock for our space, I think.
I do know of 5 groups actively trying to solve it right now.
Oh, great.
It's not too boring.
Okay, good.
It's hard,
It's boring.
but it's
That's
not boring.
great.
Yeah.
That would be great.
As the person in the
Yeah,
trap,
I'm not
like,
solving it.
sometimes
I know
it's
of
boring.
people.
I mean, like, if that'll be done in 3 weeks, I'd be good.
3 weeks? Okay, you heard it here.
That's the pace of delivery here in, like, blockchain. You guys are spoiling me.
No, but like you
too.
do have teams working on like zero knowledge proofs, like, I don't know, stuff like, okay, you have a Coinbase account, and like, if you have a Coinbase account and you're from that country, you will be allowed to trade this, for example. Like, solutions are possible, just they're not there yet, but they're possible.
Yeah. I mean, like, maybe what we need to do is, like, just take an inventory of all those solutions and put them all together.
And
that
we
we can
need the
scale
good
it.
people at the regulatory bodies to stay there and not to go to crypto companies and have more fun,
Yeah.
because they need to solve these challenges from the inside.
I won't,
Sorry.
I won't bring up the Clarity Act yet.
Yet.
Okay, we have 2 minutes left. We have a question from the audience that I know I'm obligated to ask. It's a good one. How is collateral value assessed for these private assets?
It's a great question.
You want to start?
No.
Yeah, sure. So in a DeFi construct, essentially you have a risk manager, like a risk curator, who underwrites the asset, and most often this could be an existing investor in the asset, and essentially they will assign like an LTV range and pricing. And so, basically when you are using the mechanism, there is like a sliding scale of LTV that you can set it at, but that has been sort of like pre-configured based on underwriting that has been done to set up that particular marketplace.
And back to the specific example, in this case, it would be a steakhouse. So there's a whole new market that's been created around these risk curators who understand how to underwrite these products. They're providing all of that data through these forums, and then folks can come in and read through all of that and see their analysis of the products.
So not too dissimilar to how like a credit underwriter would basically underwrite collateral. And in fact, I think, at the places like Steakhouse, they actually have just credit people.
They do, yeah.
Got it. Okay. And I can't let this panel end with Ruben being the only person in the room who's deposited on the new ACREDX. So one more time, everybody pay attention.
Everybody open your wallets right now.
Open up your phones right now.
This is like part of the workshop.
Bhaji, the directions again?
What's the minimum buy-in?
app.morpho.com.
Org, maybe, actually.
.org. Oh, this is now this is
Oh,
live.
no,
You're
it's
going
too
directly into
complicated.
Lazarus's
It's too
wallet. Be
complicated.
careful. We'll figure it out later.
Find
But
Bhaji or Neil.
Find Bhaji. This was great. Thank you very much for the time and the consideration, the intelligence for the group. That's all. Thank you.
Thank you.
Thank you.